The ability to learn real estate investing is great in the single family world. Your mind starts to work differently. You're connecting different things in it. So getting in the game is the absolute paramount thing to do, getting a good team to work with and start in a place that's much safer so you can understand the deals later.
If you're not conscious about your investment strategy, you won't end up where you want to be, not financially or as a human. On this show, we interview highly successful investors and share how they overcame limitations to become unstoppable forces of success. If you're ready to learn what it is to be a conscious investor so you can end up where you want, keep listening.
Welcome back, Conscious Investor. You know, I have great guests on the show. And the beauty of having great guests on the show is that those great guests also know other amazing, extraordinary people, right? And when we have proximity to people that have aligned interests, aligned thinking, and more often than not, they are going to expand our networks out. That's the power of networking, Conscious Investor. If you recall, recently we had Gary Pinkerton on the show, episode number 425. And he just absolutely blew it out of the water. I'm confident you thoroughly enjoyed that episode. And if you missed it, make sure you go back to that episode and then make sure you go and subscribe, go to that episode, and then you'll get a link to his podcast that will just take you further down a rabbit hole. Today, this introduction to Aaron came by way of Gary. And I'm so grateful for that because the way we think about money is critical to how we live our life. Money's just a tool. It's just a resource. It's not the end all be all. And too often, Conscious Investor, we know too often people are so focused on financial freedom that they actually distort it and corrupt it, and they don't take proper measures. It's not done with wisdom and discernment and grounded thoughtfulness. So in this conversation today with Aaron, I am confident that you are going to grow and expand your understanding of just how money really works and how you should strategize in everything that you are doing. There's so many details here, because Aaron has a vast level of experience and he's already been serving over on his YouTube channel since the pandemic. So we've got years under our belt. Collectively, between the two of us, probably have like too many episodes for you to binge on. So we want to make sure you do that. All right, let's go ahead and let's welcome Aaron to the show. Aaron, I am so grateful that you are sitting here, serving the Conscious Investor alongside with me, and that we get to jump into this really awesome conversation.
Well, I'm glad that it got kicked off with Gary starting it all off, because a lot of the stuff I get into with people is introduced them to Gary's concept. Now I don't have to get into that, right? That's right. So go back and listen to that. Some amazing data there. One of the best things in my life that ever happened was not just having Gary as a client, but then becoming Gary's client to set the foundation for family wealth. And it has literally springboarded what we have built as a family legacy because of the life insurance policies, the infinite banking strategy. So thank you, one, for the intro. Thank you for the invite. And thank you for allowing me to have the time to chat with your audience and give them a little bit of insights of what I've learned in my industry since 1997.
All right. The truth is, Aaron, I feel like I do not like buffets. So, Conscious Investor, hear this. I was literally just at an event and there was a buffet lunch. I did not eat the buffet. I don't like buffets. However, this feels like a very high end, maybe better than a Brazilian barbecue, because you have these different areas where you have so much experience and knowledge and insight to offer. I don't often do this, but I want to say, Aaron, where should we start?
So I think the best place to get going is with the current economy. A lot of people are going to wonder, is now the time to invest? There is this predominant thought process of timing the market. I don't believe the market is timable. I look at it kind of like a star football player sitting on the sidelines, conserving their energy and their time and watching intently what's happening on the field to step on when they believe is the proper timing to get on the highlight reel. It is my belief that the only people, and it's not even a belief, it's the truth, the only people on the highlight reel have their ass on the field playing, because you never know when the perfect time is. Anybody who has timed the market perfectly is ones who have already been in the game. They're already out there working. They're already doing it. They already have their baseline set. They know what their goals are. They know what their objective is on every single play, and they achieve that objective. Now, sometimes you achieve your objective, but because other opportunities open up on the field, you run straight in for a touchdown for 60 yards and look like the hero of the day, right? And it's all because opportunities lining up when you're doing exactly what you are intending to do. Now, getting 2, 3, 5 yard moves constantly is a great thing, because you'll eventually hit the end zone. You'll always hit the end zone as long as you're moving forward. So I encourage everybody is to look at the market for what it really, really is, understand what you need to be looking for, and then just go out there and get on the field. When you believe that you can time the market and you can watch things, you've already lost, because the market that opportunity will be gone, because you will not be equipped. You will not have the people. You talked about relationships. You don't have the infrastructure in place. You don't have the mindset to even understand it, and you'll never even recognize it till it's past. And anybody who can truly time the market is manipulating it, period. That's the only ways you're going to get there. So I think right now, just understanding what they should be getting to from my perspective. I know you others on here talking about multifamily. And one of the main things they said, multifamily is great real estate to get into, but you get the right operator, right? That's the hard part. Yes. The right operator, the right deal. There's so many things that are difficult to really wrap up in there. I'm a big proponent of single family residential housing. I know it's not sexy. It's not this big, I owned a 200 unit or 400 unit apartment complex. You don't have the ability to pound your chest as hard when you're standing in a big room of people. But look at what's happening in the economy. If there is a lot of data coming out that the big organizations that are really kind of running everything, the BlackRocks, the Vanguards, the State Streets, the intent. Now, I'm not sitting in their board meetings. I don't know for certain. This is just what I'm hearing. A lot of the information is coming out. Their intent is to own 60% or more of the single family houses in the United States by 2030. Now, we could be off on the year, we can be off on the percentage, we could be off completely on the objective. But when you look at what they're doing, it seems very, very credible. Now, let's say that's the case. What is going to happen with property values going forward? What we have, let's go backwards a little bit. So we had a window of time from 2008 up until 2021 that they used quantitative easing to bring the interest rates very, very low, right? You're familiar with the term quantitative easing?
Yep, but you know what? Although you and I are, let's not take that for granted, because we're in the trenches all the time. Let's back that up for the conscious investor for a brief moment.
So look it up. Number one, just to verify I'm talking about it correctly, basically all quantitative easing was a really, really fancy way of saying we're going to take capital from the U.S. Treasury, which was run by Hank Paulson at the time. Hank Paulson had a very long history in Wall Street, and they created this capital, right, Secretary of the Treasury, then handed over to the Fed, Ben Bernanke, who was an educator before coming to the Fed, right? So his whole background was on theory of economics. Then he goes into the Federal Reserve, then becomes the chairman of the Fed eventually. They took the theories that he had plus the Wall Street mindset, combined them together, took $8.9 trillion and dumped it into the markets to bring interest rates down. Now, how do interest rates act? People think the Fed raising rates or lowering rates is going to impact housing a lot. It's very small impact. It's long-term impact. What really affects it is supply and demand. If there's a great supply of money to borrow, then the cost of that money goes down, which is an interest rate. If there is a shrinking supply of it, the cost goes up, which is an interest rate. So what we have during this window of time, because of the crash that was, I wouldn't say orchestrated, but created, we had the crash. Nobody wanted to put their money in mortgage-backed securities because they couldn't trust it. Go watch The Big Short to understand why they can't trust it. Now, make sure the kids are in the other room, doesn't have the kind of language that you want them to understand, but it's one they want to watch. I show all my kids at 18 this to understand that market. Now, we understand why people, after you watch that, why nobody want to put their money into mortgage-backed securities. Now, the Federal Reserve dumped a bunch in. Well, the day they announced it, and I'll show you the charts, the day they announced this, everybody jumped in and started putting money into mortgage-backed securities, pushing huge supply into it, dropping the rates down significantly. They've kept them down up until 2017, 2018. They wanted to back out of it, but the market wasn't having it. The whole market was freaking out, so they put money back into it. Then COVID happened. Now, what's interesting is January 1st, 2009 to the end of March 2010, which is basically 5 quarters, they dumped in $1.25 trillion into that window of time to get this whole process started. Now, then you get to COVID, far advanced to March of 2020. By March 20th, 2020, because the massive impact COVID had on the market shut everything down, to March 30th, 2020, 10 days, they dumped in $1 trillion. What took a year before, they did in 10 days. Significant impact on the market interest rates. And what did that do to us? It had all of us buying housing at a rapid pace. You had realtors, every time you said they want to buy a house, saying, be willing to come in with $30,000 to $40,000 more than list price just to get in the game, just to start your offer. And nobody bitched about that. It's like, oh, that makes sense, right? Because the cost of money was so low. But what had happened is we pushed the cost of housing extremely high because the rates were enormously, unnaturally low because of how it was manipulated. So now we have housing so high that it's way beyond where it should be based upon our current interest rate environment. And if you look at the rates of interest rates, in fact, I'm going to share a screen real quick here. If we look at interest rates during the past, all the way from 1971 to today, you'll see that the average interest rate from 1971 to today is 7.74%. This is actually updated in June 22nd. So a little while ago, this is about 3 months old, but 7.74% was the average interest rate for the average person buying a house to live in. Now, if you take out the quantitative easing we just discussed, that the Fed had taken $8.9 trillion, manipulated the market to bring it low to get us to spend more money on houses, the average interest rate from 1971 to 2009 was 9.12%. So if we're looking at interest rates today, according to bankrate.com, is about 7.6% for your average homeowner. We're still very low compared to any of these averages. 7.74 since 1971, 9.12 anytime before the quantitative easing started. And if you start looking at what we've seen just in the window 2000 to 2008 is what I'm really kind of focusing on. We're about 6.48% was what people were used to getting that were buying houses pre the crash. So one of the things, and if we look also today at Case-Shiller, we start looking at, we see here, CoreLogic and Black Knight, they all came out with data saying we're going to see about an 8 to 8.9% increase in house prices just this year alone, given current data. So where am I going with all this? Everybody thinks the cost of housing will go down because the rates have gone up. I just showed you that we are still lower than the average interest rate prior to the Fed manipulation. Now we have pushed the price of housing through the roof. We have a large behemoth walking around trying to gobble it all up. And the only thing that we can do is get in the game because it's going to keep going up, where they're trying to create a subscription-based economy where everybody pays on a monthly subscription to live. And if you're not in the real estate investment game now, especially with single-family housing, which I believe will be the most valuable real estate out there, then you will be the subscriber, not the one providing the subscription. You need to get involved now. What's really, really, really cool about it is our current rate of inflation. Do you know what the current rate of inflation is today, Julie?
Off the top of my head, no.
So a lot of people look at what the CPI is coming in at. They're looking, well, the Fed's saying it's 4 point whatever percent or 3 point whatever percent. If you look at the real rate of inflation, that's very, very low because look at where our cost of living is not going up by that. If you go way back into the 80s, there's a place called shadowstats.com, that's in Shadow Statistics. You guys all go there yourself, take a look at that, go to the alternate data tab, scroll down to inflation, and you will see the two different charts that John Williams put together. One of the charts showed a massive divergence back in the early 80s. They used to follow the actual cost of living, right? If you were going to live a life eating steak every day with potatoes and driving your car this many miles, doing this and this and this, this is where your cost of living would go, and they would track that. But then it got to a point, it's like, cost of all these things is going up. We're going to adjust this. We're going to do a substitution method. Maybe you're not buying steak every day. Maybe now it's chicken. Well, now chicken's become expensive. Now we're going to do hamburger, right? Now we're going to go to Spam. We're going to do all these things. You can still live your life. You can still eat 3 squares a day, but it's going to change because of the cost. So they're doing a manipulation of that. The other thing is they started only tracking certain items they can manipulate with monetary policy. So the real rate of inflation is over 12% right now. If you look at the average rate of inflation since the 80s until now, it's been well above 8%. So I look at inflation averaging 8%. Average of 8% of our interest rates are over 7%, and your money is losing, with inflation, money is losing 8% of its value every year, which is 0.666% of its value every single month. Who wins when you borrow money at, say, 7.5%, but the dollar is losing 8% of its value every single year. I'll ask you, do you believe wins in that environment?
I believe the government and whoever holds the notes on those.
Actually, the person who borrowed the money. So let's take a quick look at this other chart that I've got.
I love it when I'm not right. This is why I love having experts on the show.
And so this chart comes, I was theorizing about this on a podcast, and I've been a guest on well over 200 business podcasts, and the professor of accounting at Kennesaw State University heard me on the podcast, says, you need to come speak to my students. And then after that, coming out and speaking to the students of the accounting students, we talked about how to calculate this, and he created the calculator for me. So what you have here is we're going with basically anybody who's watching here, I've got a calculator that'll show you your amortization schedule on a house, what you're actually going to pay in principal and interest, and then what the value of all those dollars are over the 30 years as you hand it off. Because every time you make a payment, the dollar is worth 6.666% of its value less than its value the month before. So in this example, we have a 30-year fix, which I'll always advocate do a 30-year fix. Anybody that says pay off your mortgage early, quit listening to them. Walk away from that person, call me. Go to aaronchapman.com, talk to me. And I'm very confident in my conversation here. So we got a $200,000 purchase price. I'm using that because I just actually went into contract on a $200,000 house here in Springfield, Missouri. And then you've got a loan putting 20% down with a loan amount of $160,000. Now, with an interest rate of about 7.625%, which is what we're locking the majority of our people at right now, 7.63, you're going to pay over 30 years $407,689.20. That's because your principal and interest will be $160,000 principal, right? You're paying back what you borrowed, plus interest of $247,689.20. Most people will say, that's too damn expensive. I need to pay that off. But go back to what I was saying. Every time you make a payment, the dollar is worth less. This column recalculates every time the dollar leaves your hands. You will be paying $154,336.97 in actual dollar value over 30 years. You are winning because you pay back less than you borrowed. Now, let me illustrate why this works. Back in the pre-1920s, they used to mint a 1 ounce $20 gold piece. You could walk into a department store, as I understand, I wasn't living back then, and buy a tailored suit, a shirt, a tie, a belt, a pair of socks, and a pair of shoes for that $20 gold piece. Can you walk into a department store today and buy $20? You cannot. But you can with an ounce of gold, because what is an ounce of gold worth right now in dollars?
No, is it 1,800?
Right around 1,800 to 2,000 bucks. I know this because I had to get a suit made, and I had to buy all that crap because I go back and forth to DC and I meet with senators and I meet with members of Congress to talk about affordable housing, low-income housing, and the real estate investor and how they will help offset that. So I had all that done, and I know it will cost that to get my suit and get my belt and get my socks and get my shoes and all these things. Now, depends upon the suit, right? You can spend a hell of a lot more than that. But nowadays, you can't buy a pair of socks for $20. And it's not that the gold became more valuable. It's not that the suit became more valuable. It's the instrument that we're buying it with has lost so much value that you need more of it. So that's why locking in a 30-year fixed interest rate, paying that solely over 30 years, benefits you so significantly. So let's do some quick math together. And this, once we do this math here, that's where we're going to have to stop, because then I'll get into the deeper stuff with the family, about family and how we do stuff on another podcast. And it's only because I'm on a time crunch. So really to get into the value of real estate, the extreme value of real estate, we need to put the numbers to it. So we already talked about the time value of money, how you never even pay back what you borrowed. But I tell everybody when they say, well, what should I buy? You need to look in markets that you can find a home, a single family, duplex, triplex, fourplex, whatever it is, that you can keep reasonably rented the entire time you own it, and you can raise rents on it. Now, let's do some quick math. Are you okay with some?
Absolutely.
I'm not testing your skills. This is just us syncing up our brains and the brains of everybody who's on the podcast with us, listening. Run the numbers and see that what you're seeing here. So we talked about a $200,000 house already. And we said you're putting 20% down. How much is 20% of 200,000?
About $40,000.
$40,000. So you're getting a loan of 160,000, right? And let's say in this environment, there's points and there's those things. Let's say you're putting $10,000 between lender fees, title fees, appraisals, inspections, taxes, insurance points, all that. Now that's excessive. I'm just using that as a round number. So you've invested how much of your money?
$50,000.
$50,000 invested. $160,000 invested in your partner, which is the mortgage lending industry. So if you did your job right as the CEO of your investment business, which is to find the right property with the right people, it stays reasonably rented the entire time you own it, who pays off the $160,000?
The residents.
The tenant. Exactly. The person sitting in your house using it. Now we're going to take this. So you've invested $50,000. The tenant's going to pay off $160,000 over 30 years. Take $160,000, divide it by 30, and they'll tell you how much per year they're giving you. Now, this is averaged over 30 years. I know there's an amortization table, but this is simple math.
Okay, so it's like 50 something.
It'll be $5,353.37 to be precise.
I'm like 3 into 16. And I'm
going to do the math here myself just to make sure, because I've run this example 100 different ways, and I'm pretty sure it's 53.
It is
160,000 divided by, and guys, just do it divided by 30, and you'll find it is, and my calculation, it's messed up. So 33.37. Okay. So what percentage of your 50,000 is that every year?
Tell me what it is. I'm like, I'm so into this conversation, and I'm like, I'm just here, and I'm like, oh gosh, I'm not the mathy, like on the spot kind of person.
You do the math, Chapman. I'm the facilitator. So when you do that, when you figure out what percentage that is 10.6% of your investment of 50,000. Yep. You're literally making, by having somebody pay off the mortgage, 10.6% of your initial investment. Every single year you keep people in there, not even making any cash flow, guys. That's not cash on cash return. That's not cap rates. That's just them paying off your loan. You're at 10.6. Now, we live in an inflation environment. We just talked about it. Because of that, the cost of housing is going up. We just referenced Case-Shiller, Black Knight, and in CoreLogic says we are experiencing potentially an 8+% increase in houses year over year. I don't use that number. I cut that way down. They used to estimate 5 to 6. So I took the 5 to 6, I cut that in half to 2.5. So if we only had a 2.5% increase in the value of this house, you bought a $200,000 home that you invested $50,000 of your money, and it appreciated by 2.5%. What's 2.5% of 200,000?
Don't put me on the spot again. I failed. I'm like, oh my gosh, my confidence is totally gone right now.
There's a lot of everybody right now is like, oh, just Chapman say the answer. It's $5,000. Do the numbers, guys. Take that, divide it all out. You'll find it's $5,000. That is equal to 10% of your 50,000. That is literally another 10% increase on your 50,000 just by the property appreciating by 2.5%. And it's a compound 2.5%. But we also know it's going to be higher than that. So you got to be cautious where you buy. Can you get somebody to stay in it because it's an area that people want to live in? Is it one that you can at least get a 2.5% compounding appreciation? If you can get that, you are literally making 20.6% on your money before cash flow, before cap rate, or before tax benefits. Where else are you just crushing? The podcast you had to watch, they talked about you have to beat the market, right? Beat 8%. You are literally obliterating, crushing, and pounding the freaking market into the curb and kicking it in the back of the face just by having somebody living in your property, paying off your mortgage, and being in a market that appreciates at least 2.5%, 20.6%. Where else are you going to get it?
Multifamily and assisted living. No, but I hear what you do. Like, I hear you. I resonate with this. My husband actually is. Right. I'm sorry?
No, I'm with you. I'm with you.
Yeah. I'm all about all real estate, all real estate all the time.
So, and the illustration I'm giving here is the simplest form of getting into real estate, right? You can get into multifamily, you get into assisted living. There's a lot more moving parts, of course, a lot more management involved. With more management, with more moving parts, there's more risk, but there's also a lot more reward in that one. That's going to have greater cash flows. But if you just want to say, okay, I want to kind of tiptoe in, I want to get my toe wet, you can't get a better opportunity than single family residential housing or duplexes, triplexes, fourplexes, because you can get agency financing for 30 years. Now, there's some financing out there you get for 30 years, and some of these other opportunities are not as prevalent, but they're there. If you get 30-year fixed financing, that's what you get. If anybody tells you get something else and 30-year fixed is available, you step away from that person. You go back to the 30-year fixed for the reason I just told you. So there is opportunities, huge opportunities out there. don't walk away from the single family opportunity that might be sitting in front of you because it's just not sexy. Not sexy gets you a long ways in a long period of time. Now, we in my family, we've used the infinite banking strategy. We said create a family trust. We have our kids get together. They vote on everything that we purchase. We do this as a group, and then we do that in a way so they can understand it. So when I pass, they have the capability to keep running things, because I'm not setting up where they can just take the money and spend it and run with it. And the other thing is, I use the life insurance policy because I'm going to use all my money. I use my last dollar the day I die, hopefully hunting in Alaska, because when I do pass, they're going to get a windfall of capital to work with that they don't need my life. Well, we all have this whole value of life and whatever, but as far as the monetary side of it, there'll be more than enough so I can go live my life. Don't ever walk away from the opportunity that these life insurance policies present, because you can actually live a life that you want and not have to keep setting things aside, limit what you want to do because you want to leave something for the family. That will leave plenty for the family.
Mm-hmm. I love this. I want to step back just a moment and say, I think what's also important is one of the areas where I think that I am differentiated from other commercial real estate investors is that I value a diverse real estate investment portfolio and having those smaller assets. And it's so conscious investors, this is about understanding what are your goals. So you want your immediate goals might be, I want this cash flow. And I also want these longer term goals. And so when we invest in the single and small multifamily on our own, and we're diversified into larger commercial real estate, we have this big, beautiful ecosystem that is just going to flourish.
100%. And the one thing about having the single families and all that stuff, it gives you a lot of liquidity. It's the easiest one to divest of, so you can continue to keep building your Rohimas out here. But I would not ever be in a position where I would discount my capability to continue to keep getting single family, get your investments. I have a 200 unit apartment complex. I've got multiple single families. I've got lots. I've invested in businesses. I've got money deployed all over the place. I only go, anything I put in, I try and limit what I put into it unless I understand it well enough to dump in more than that. So as you're tiptoeing into it, limit your investment. The ability to learn real estate investing is great in the single family world. You're also a limited amount of capital you have to put into it. Your mind starts to work differently. You're connecting different things in it. You're starting to get more. I think Joe Dispenza talks about these neurons connected to other neurons as you're thinking different things. You're solidifying those connections. You see opportunities better. So getting in the game is the absolute paramount thing to do. Getting a good team to work with and start in a place that's much safer so you can understand the deals later.
Let me ask you this, because I'd love to just, I speak to so many of you conscious investors that it's like, okay, I can hear this question. All right, well, hey, Aaron, this all sounds really great. I am already invested over here in commercial on the passive side. Yeah, I want to pick up a tri, quad, single family. I don't care if it's sexy or not sexy. It's a purpose behind it that's what matters. But I just deployed my last $100,000. So I have no more liquidity, but I want to do this. So at some point, right, people face that challenge where they're like, I want to go for this and I feel trapped. Mm-hmm. Everyone has interesting recommendations on this or insights. I'd love to hear what yours are.
So I've worked with a lot of people in different parts of the country where we've utilized hard money to purchase a property that can be purchased in rehab for a certain price. They refer to it as the BRRRR strategy very commonly. And then we actually set up well in advance, get the pre-qual with their financing done well in advance, get them set up to where they can go and get that hard money, buy that house, work with operators that have a pretty good track record. It doesn't work perfectly every time. Track record that property's value after the rehab is done will be high enough to get a refinance off that to pay off the hard money and then have no more money or very little brought to the table. Now they own a house that's 100% financed, that has equity in it, they didn't have to bring any money to the table on. That's prevalent out there. We've done that quite a bit. I'm working on some things in the background that'll make that even more prevalent on a national basis, but it's still in its infancy. We're still ironing out. I'm supposed to have calls later this afternoon to keep working with this team of financial engineers to get this all done. But there is opportunity. Now, that's just one. There's a bunch of different opportunities out there. Hell, just go look up Robert Allen. He's a very good friend of mine. His book, No Money Down, written in the 80s. I've got a book that I'm coming with next year. He wrote the foreword. It's going to be rather disruptive. And that's another thing. There's tons of different ways to go about this. The other thing is just be consciously building up your capital somewhere in a place that's not just sitting in your bank account. Going back to Gary's podcast, get that infant banking strategy going. Take all your extra that's coming in, keep paying down the policy loan. So when the time comes, you see an opportunity, grab it, pull the money from there, redeploy it. That's how I built it. Because you may not have it now. Continue to keep putting it back in some place in a mechanical process. You can create a machine that will actually continue to compound itself.
That's such sound advice. I love this. There's so much going on here. I love that we've, covered like timing the market, being on the field, actually being active in your investing, understanding the power and the pulls of the supply and demand, and really honestly, just the insights of, I'm third generation in real estate, and so I've lived these different economic cycles, and a lot of this makes sense to me, and I'm not freaking out over all these interest rates or all these different things taking place. It's like, well, that's fine. It's just the latest flavor of the challenge, like whatever, it's a new hurdle, no big deal. So all of this is just so insightful. I know off air you were talking about you have an app that you've created. I'd love to share more about that with the conscious investor.
So the conscious investor can go to their app store and look up the QJO investment tool. And it's referred to as a quit jerking off investment tool. And that's why I named it that way, because that's what people are doing, worrying about interest rates. So you get the QJO investment tool. It's right there on both the iPhone and Android. You can download that, and it has the third calculator, your mortgage amortization calculator. I'll have Bree send you all the data where it has the videos so they can show how to use it. Bree will send that to you, so you can put that up in the show notes. And it helps people to see exactly what I just showed you, how inflation impacts everything as far as your long-term investments. And one other thing I want to share with everybody is that's going to be the give. You guys got that to work with. It cost me a significant amount of money to build that. Don't charge for it. It's a free download. But one thing I did want to at least have everybody take a look at has to do with the mortgage-backed securities and where they're going. The mortgage-backed securities are not letting us go into a position where things are going to get better. And if you look at this channel that I've drawn, things are continuing to decline as far as the securities are concerned. We're going to see a point where interest rates keep going up. I don't know when that stop is going to happen. I hope it's going to be down here before we flatten out. But that means your average interest rate for the average investor is going to be over 8% when that does happen. Don't be afraid of the rates. I show this because I want you to understand that our interest rates are going to go up. They have to go up. They should have been going up all along. There is no more of this public capital to keep putting into it. That public capital did nothing but create inflation, did nothing but create a buying frenzy on real estate and pushing prices through the roof. And we have been conditioned to continue to buy that way. We've been conditioned to push these prices up. This is a conditioning that's been done over the years. We now have a generation that has a complete different belief on interest rates. Now that's generation that probably will not buy. That's a generation that now will rent. That's a generation that will be subject to these big behemoths I talked about if we, the conscious investor, don't get out there and block them by buying it ourselves. That's kind of my statement here.
Now, I love this. Okay, I'm going to ask you something so off topic. I live in very far north Idaho. Conscious investor, you've heard me, joke around about this. I live in conspiracy capital of the world. So we're just going to have can we have just like a moment of fun? Just
sure.
Good spirited fun. Conscious investor, join us for this good spirited fun. Is there a conspiracy theory behind that? Like, I can make a conspiracy theory over anything by nature of where I live and some of the things that I hear around me. I'm like, okay, I can generate one. And what I'm here, kind of what came to my mind is I'm like, wow, did they keep the interest rates low for an entire generation just to condition them so that they can create this subscription-based economy?
Well, when you think about it, all I'm doing is looking at the data that they're releasing, right? This is what we want to do as far as just, kind of like, I don't like to throw out the Schwab statement, but, you'll own nothing to be happy, right? So you have that thought process. There's enough evidence that says you've got these three major corporations that own pretty much 80% of the S&P. They have what they manage under their management is larger than all but two countries' GDP. Right, the U.S. and China. They literally dwarf all these GDPs just in what they have under management. You can't say they don't control the markets, right? They don't manipulate the market want to. Those people who were pulling all those strings and knowing who was in the background during the quantitative easing decisions and what was forced upon us during the quantitative easing decisions and all these things, like, it starts to make sense. This is not necessarily a theoretical thing in the sense it is my theory, of course, but it is by taking data that we've seen and what the goal is, and like, what is the psychological effect on the individuals who are living through this? Because a really good salesperson, right? You have to understand psychology. I don't know if you got anybody who's read anything of David Sandler. He talked about psychology of sale. If you understand what the person thinks on the other side, you can bring them to the destination you want them to get. They're very patient. They've been very patient. And they're pushing the cost of housing so far out of the hands of your average buyer. And they push the interest rates. They just let it go back to where it was. They didn't push anything. They just pulled all that money back, and they'll let the market go where it was going to be. If you look back in history, in fact, I'll even pull up that chart. If you look back on it, we are literally where we were pre the crash. So I'm going to go ahead and show this right now, and I've drawn this out to show the difference here. At least all this capital represents all this trading up here represents during quantitative easing. All this happened. If you see this yellow line I've drawn, and we're intersecting this with this right here, this green one, that is the day they announced quantitative easing. The day they announced it, we had not decidedly stayed above that until they announced it. Bam, we stayed above it consistently for 13 years. And then they let it go right back to where the market was, driven by the market. So the market is operating at the same value, in the same way it was before, with the same amount of volume it was before, a similar amount of volume. But what they did was use this time to drive the price of housing through the freaking roof. And now we have a huge amount of money chasing single family residences. So it's my belief that we need to get on board and stay on board, and as much as you can safely. Don't buy stupid places, right? Don't buy in some sort of podunk town, New Mexico that has nothing going on, right? You need to go to a place that has jobs, that has a need to be there. So it is my belief that that is one of the strategies to continue to grab housing, push it out of the hands, because it's not even their money anyway. They don't care. It's investment capital. It doesn't matter to them. And if they can continue to keep pushing the price of housing up 8% per year, look what it's doing. It's beating the market. It's beating S&P, but it's also compounding on like with what we're doing. We're putting 20% down, so we're controlling something with 20 to 25% of its actual value, but it's going up at that percentages, which means our percentage goes up significantly. You're seeing 10, 20% increase on our investment because what you are now controlling is going up by small amounts. So if you apply 8% to what we were talking about before with your 50,000, look what that does, right? Now it goes up, probably 30% just in the appreciation on your money, not just 10. And then you still have that 10.25 or 10.6 from your tenants. Now we're looking, 40% annually? It's crazy. It's absolutely crazy. So again, it's Aaron Chapman's theory. It's not something that is being published by anybody else. I'm not reading somebody else saying this. It's just me piecing stuff together because I look at this every single day and I put something out twice a week on it.
This has been one of my favorite. It's such an interesting and important conversation. And these are conversations that aren't out there in the mainstream. They're not the common conversation surrounding these, concepts. So I'm truly grateful for your time, your expertise. And I deeply value, and I know Conscious Investor, you do too, people who are willing to do the work to learn to investigate on their own and use their own brain power, experience, knowledge, and everything to draw their own conclusions. So I appreciate it so much. And I appreciate it also that, you're hitting the, DC and supporting and standing up, like, hey guys, we got to do something about this because we need advocates like that. I was reading Ryan Holiday's book this morning, and it was like, where were you? We don't want to be on the sidelines. We need to be taking action, even when it's unpopular. We have to be raising hell. I also, we push a lot towards Operation Underground Railroad. I'm very close friends with Tim Ballard, and also the director of the movie Sound of Freedom was Alejandro Monteverdi. I'm very close friends with all these guys. I've interacted with them in many different ways because that's another thing. There's two big things that we're dealing with in this world. There's human trafficking. There's a massive issue within our borders and out of our borders, and we also have our financially we're on a very, very unstable ground that's being manipulated. The only way
that we can do anything is actually take action. People need to do something. Take control of the real estate that's around you, and also do something to support this. It's on my website, aaronchapman.com. You scroll down to donate. You can see that we donate there. I actually have an event that I'm going to be putting together in Memphis in October, where I have the current head of operations globally for OUR come to speak at that group of investors. So we're doing everything we can to try, and there's more that we can do, constantly more that we can do to try and do more. But as you said before we started, we get completely yanked 1,000 different directions. We don't know. We don't have a moment to ourselves. And I'm going to have to take off here, but I want to close this as some encouragement to people who feel that way. It says, this came out, this is an anonymous author out of the Anglican Digest. I think it was published back in 1910, 1920, where he said, when you're exasperated by interruptions, try to remember that their very frequency may indicate the value of your life. Only people who are full of help and strength are burdened by another person's needs. The interruptions which we chaff at are the credentials of our indispensability. The greatest condemnation that anyone could incur, and it's a danger to guard against, is to be so independent, so unhelpful that no one interrupts us and we are left comfortably alone.
Mic drop. Absolute mic drop. That's so powerful. We'll make sure that we leave a link so that you can kind of ruminate on that quote. Aaron, I know you've got a lot going on. We talked about off air, so I want to say thank you. I know we talked a mile a minute. I loved my math lesson today. And I love calculators. And I just want to say thank you again for joining us on The Conscious Investor. And Conscious Investor, let all of this stuff, if it ruffled your feathers, good, because that's when we feel a little unsettled about something or feel like, wait, you just poked a hole. I mean, I'm in commercial real estate, but that Super Ad Steve is in small multifamily and such. Like, it's important to poke holes in the things that we deeply believe so that we can, validate and verify, is this true? Is this accurate? Is this still true? Is this still accurate? So have an informed having the wisdom, discernment, so we can make informed decisions. Aaron, thank you again. And Conscious Investor, until next time, live big, love bigger, and do great things.
What's the big deal about investing in apartments? Why is it better than investing in a slew of single-family homes? I've compiled a lot of information on why investing in a multifamily, also known as apartments, will help you reach your investment goals. Head over to 3keysinvestments.com and download the Why Invest in Multifamily guide today.